Hello and welcome to Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lucas de Pourbay. I'm Fidelity's global cross-asset specialist, and today we have a special episode. We're joined by our global CIO, Andrew McCaffrey, as well as Paul Taylor, portfolio manager for our flagship Australian equities fund. And today's episode will be a slightly longer episode because we are talking about a broad range of topics ranging from inflation, the economy, geopolitics, as well as touching on some investment opportunities for the year ahead. So please refer to the podcast notes, and the various topics will be time-stamped if you want to sort of skip to any of the topics that you're particularly interested in. Welcome, gentlemen, and thanks for being here today. And we're hopefully going to have a really interesting discussion. And I picked up that you've just clicked over 40 years of investment experience, which is phenomenal. And over that time, if you reflect, over those times, I guess there's been a whole bunch of market environments and evolutions in terms of the financial services industry. But what I was really interested in sort of exploring is just a couple of, over that 40 years, you're constantly learning in terms of markets, and markets change. What are the sort of the top, say, three things over the last 40 years that you've sort of learnt in terms of being in the markets? Because the markets can be very unforgiving and they keep you honest.
Yeah, the first thing is that you must never stop learning and being open-minded enough to take in everything that you get a chance to view, see how markets, people react. Never forget that psychology is an important part of markets because of that sentiment driver. But it's also, at the end of the day, one of the biggest things is that has never changed, is that doing high quality core analysis, really understanding the investment that you're making is essential, because you mitigate as much risk as possible and before you make the investment, but also that understanding of what you're looking for and how your thesis for the investment will play out is so important to be thorough when you start. But I think markets have changed enormously in terms of size, liquidity, and the instruments and the way in which you can take investment risk. And although at the core of it, you need to understand companies, if you can get that right, you're going to be very successful. But the way in which we can invest around that and the types of everything from derivatives to the growth of ETFs in our industry, just continues to show that we do evolve and work out how we can best put capital to work. And, if there's one thing that I've seen is that we are quite capable of misallocating capital over cycles, but we're also hopefully can allocate very efficiently, and that's how we grow over time.
Yeah, absolutely. Maybe we'll sort of start diving into some of the bigger macro things, because definitely that's sort of certainly your wheelhouse. And one of the things that's we're seeing more and more in the media certainly is this concept of soft landing. Now, it's certainly gained traction, feels like, over the last sort of 6 months or so. What is soft landing? What does it mean? Because it's sort of, everyone sort of uses it, like everyone sort of assumes as, we all know what it means. But what does it mean? And I guess, what is our view with respect to this soft landing scenario that's been used quite widely at the moment?
Soft landing is that you keep the economy growing, but you get inflation down to target, and we have that wonderful environment of disinflationary forces, which are so positive for economies and, for that matter, financial markets. Now, our view is that the soft landing as a scenario has certainly increased in probability. And I think there's a few things that really influenced our thinking on that, from where we were most probably looking back to coming into the fourth quarter, where we'd seen elements of no landing, i.e. that there was fears of inflation picking up, fears that rates would stay higher for longer, that the economy would potentially be re-accelerating, but that would mean decelerate more rapidly later. And those have gradually played out to be not quite the concerns that are had there, because, one, data has been better generally in the economy, but the disinflationary force has intensified. And from our analyst survey that we do annually, which is a forward-looking profile, then the inflationary pressures have been abating. And so companies themselves see that costs are not going to be the issue that they were. They could even decrease. So you could actually see prices continuing to fall. That's very positive for that soft landing and for central bank policy. But we're also seeing that growth has been able to continue to be fairly robust. And that not impacting that disinflationary force as we go into 24. It's often also used as the Goldilocks environment where, not too hot, not too cold. Do we stay there? That, I think, is the big question as we go into the second half of the year, but not for where we are today.
And Paul, from your perspective, I mean, that's certainly a global view. From an Australian perspective, do you see a similar scenario, or are there any sort of nuances that you think we should be aware of?
Well, Lucas, just before I get into that, I'm still stuck on the 40 years in financial markets. You must have been like a schoolboy when you started in the industry. And so, I think that's fascinating. Actually, 40 years would be interesting too, because that probably would have been around Big Bang in the city, wasn't it?
It's October 83, and I should say that, being in financial markets, it's different from you administering a few money market funds for a senior person versus obviously having the opportunity to meet the biggest investors, be part of policy making discussions and regulation. 40 years later, a big learning journey. But yes, I was very young.
It's been a great journey. Look, I think with that little sidetrack, I think Australia is similar. Right? So we've economy is slowing with the higher interest rates. That has definitely impacted the consumer. We are slowing. I think we have been quite fortunate in a range of different areas. We don't think a recession will happen in Australia. We think we'll be well positioned. I think we've definitely been helped by commodity prices, commodity markets. We sit here today. Iron ore is $130 a ton, which is that's a strong iron ore price. And in fact, if I was just to see $130 a ton, if I saw that, I'd think actually China's quite strong, and maybe that's a topic we can come back to. I think the government has been fortunate in tax revenue, because of those really strong commodity prices, which has definitely helped their balance sheet. So, corporates remain in a really strong position. Government, some debt has increased because of COVID, still in a really strong position, and that's definitely helped the overall economy. The other thing I think that's been extremely helpful to the Australian economy has been population growth. So, during COVID, we pretty much stopped any movement of people, and then as we've come out of that, we've restarted immigration, and that does cover a lot of sins. When population's growing 1.5% to 2% a year, I mean that's growth. That's more people, more goods, more services, more houses, and that can actually drive the economy, all by itself. So. So our outlook on Australia is very similar. We think it'll slow, but still be in a relatively good position.
Mm-hmm. So this sort of Goldilocks scenario, as you put it, in terms of a soft landing, does that mean that the inflation journey is being put back in the bottle? Is it clear sailing for now, or what are some of the things that we should still be aware of with respect to inflation? Because again, it's probably a topic that for the last 2 years has dominated a lot of client conversations. So what are some of the things that, we should be aware of, though, and keep an eye on in respect to inflation? So
I think one of the things that's important to bear in mind is that when you start to see sort of disinflationary forces, that as always, things can overrun on that level as well. So the risk of seeing something below target intensifies as people get comfortable, especially for companies, that if their input costs are going down, their margins being retained, they can actually pass some of that through to the consumer. And that's where our survey really was sort of highlighting that the potential in some economies to develop. But the backdrop is one of increasing structural inflation pressures in some ways. We have decarbonisation and the draw on materials to be able to achieve that. The effect of having to build and develop things before you're removing, some of the existing infrastructure, some existing elements that we rely on. Reshoring. Really important area that we've seen the growth of plants being built around different countries of the world to help in supply chain management. Some is politically driven, some very clearly is very sensible commercial decisions and trying to create protection against where they see some of the risks around their supply chains today. And then the other, which actually most probably isn't discussed in the medium term as much as it's been short term, has been around wages and the fact that we've seen real disposable income actually go up last year to a point where it was positive. And so moving out of what one classifies as stagnation for so long has actually got a positive dynamic. Well, if you look where we are, inflation has been coming off, but those wage agreements are kicking in, so that disposable income is actually increasing, which should give more confidence. So again, some of these things looking out further, and when I say that, it's sort of medium term, measured in years rather than in months and quarters, then those pressures suggest that the average inflation level actually may be higher. And I think there's an important part in here that Paul touched on, from how Australia has managed support from the government, the fiscal stimulus. It's been there, but it doesn't look anything like the levels we've seen in the US or in the UK as well. And that's something that, again, that it's a double-edged sword. It's been very positive for keeping growth running, but that tends to have more of an impact, again, feeding through to inflation because of how you get not just the multiplier effects. They don't have to be necessarily negative, but what it's doing is coming on top of what has really been the available level of money has gone above trend rate of growth that for a while now. And so these are factors that actually keep up some of those pressures in the medium term. And so I think that Goldilocks now, and maybe we chat about where interest rate expectations are, keep oscillating around. But the reality is generally it's a favourable outlook. But I think that, if we start talking about 25, 26, some of these pressures I've just mentioned start to appear more visibly again.
And some of the longer term inflation, decarbonisation, is a longer term inflationary issue as well. I guess that can work under the economy, yeah.
Yeah, and I think that the part there is that it's one of those where we sort of wrap it up in this sort of idea that, it has to happen, but also at times it ebbs because we think, are we going to follow through on some of those policy moves and so on? The reality is the direction of travel is very clear. It's just a case of the speed we move. And then the other side is that if you roll back to the GFC, that a lot of the productive capacity was never replaced when that was pretty much shut down or suffered from the deleveraging in many parts of the economy. And that element, I think, is also going to play its part because as you see some of this sort of, we look at the transition economy, so much of that's decarbonisation, but, if that's 1.5 trillion, which is what we sort of, calculate from what we can see from policy implied moves, that per annum is going to mean there's going to be times when, there's going to be raw material blips, and that's going to have an impulse at times. Now, it's not sort of sustained, but as if you go through that constant profile over time, the risk is that it has an inflationary impulse because again, people are going to be employed, that they're going to have better incomes, their consumption levels are going to stay higher, and it means that again you're going to have that little risk of that every and again actually it's going to push up the price level within various economies, various activities, and I think that's the part that to your point, Paul, is not going away for some time. And so it's not a constant, but it will at times be quite a sort of strong impulse to inflation.
I think one of the interesting both of your views on this, but what, if you're talking about inflation, we're talking about sort of non-labour inflation coming down in terms of some of the inputs there. But I guess in terms of wages, I mean, for anyone that's been running a business of any sort, whether it's a small business or a large corporation, and, we've seen it in some of the earnings announcements, but, wage inflation and the cost of just hiring people and keeping people is over the last couple of years has gone through the roof. How do you see that playing out over the coming years?
So I think this is actually one of the really interesting sort of events of post-COVID in terms of how it's impacted corporate thinking, because I think there's a couple of things that are at play here. One is the people who were laid off during that COVID period, and in the US is a good example because it was such an extreme where they actually got paid more from the government in some cases than the jobs they had. Because they didn't have the expenses going on as well. So, elements of quite a positive, income effect for those. But for the companies, what they saw is they laid off, people were comfortable. But more importantly, when they came and they saw that actually growth was not slowing, in some cases accelerating in some parts of the economy, in some sectors, then very quickly they had to rehire. And what they saw that was such a challenging part for them is that the cost of that rehiring was 20 to 30% higher when you look in US as an average. And that now I think has stayed with them. So you have a sort of almost like a recency bias, is that's very vividly in their minds of what it costs them. So I think they're going through employment hoarding now. And you see it in some of the data where what they're doing is letting the hours work drop a little bit so they can keep people on, because obviously the cost has gone up to a degree. Because one of the other parts of our survey was just that there's a more optimistic view of where things will be in 12 months' time than where it is today. Well, you're not going to lay off and run the risk of having to come back and hire at higher cost again if you can just lower some of the working hours now to sort of let some of that tension go, and then keep people on and obviously be prepared for that better growth trajectory you expect.
Paul, from your perspective, I mean, when you're seeing companies out there and you're obviously covering the whole market here in Australia, I mean, what are you seeing on the ground in terms of that whole dynamic? Yeah,
look, I definitely agree. It's labour cost is a lag. It's lagging to the non-labour costs. And in Australia, right at the moment, we're seeing the industrial relations legislation just pass, which is all about that, all about those conditions. And I think, people have had, their costs have outstripped their wage growth, and there's a little bit of catch up now. So, having said that, it still should be a sort of a cyclical factor. So we're seeing that catch up now. We're seeing some legislation changes. Businesses obviously aren't happy about it, but that shouldn't continue. That's not some sort of structural long-term issue. That's more a cyclical short-term issue. And as non-labour costs start to ease and come back, that will take the pressure away from the labour side as well. So it's definitely there, and companies are, it's happening, but it shouldn't be a structural long-term headwind.
Okay. So maybe we'll round off the whole inflation discussion with view on interest rates. So if you think about the central banks over the last, certainly in the US, there was a lot of excitement late last year. The Fed sort of signalled that, the rates cuts will be coming, and the markets got really excited. And certainly from an Australian perspective as well, there's a lot of the anticipation as to, when and how big will rate cuts be. What's our view on rate cuts? When will they happen? Will they happen? And I guess the materiality of those rate cuts, are they going to be big, small? What are your thoughts on that?
So I suppose, again, I'll talk to the US because that's really where you got the impulse from when it's very clear there was a series of events that sort of took us out of the no landing view and got us into this soft landing run we're seeing at the moment. The first really comes from some of the concerns around debt and issuance that sort of moved from being front of centre to being calmed down by some of the projections and the announcements around issuance in the US. At the same time, we saw good inflation data, and then we saw Chairman Powell say pretty much a sort of pivot that you've reached this point where we can start thinking about the pathway towards lower rates at some point in the future if we continue to see this improvement. The reality is we have seen that. But what it did is it sort of set off what I think were a lot of factors that people were short of markets. They'd traded effectively to have rates stay higher for longer because they've been told that. And all of a sudden you saw a reversal in many of those factors through the market and get excited about where it could go. I think that the arguments that were driving there were very much that if they're going to pivot, everyone looks back in history and says, well, they're going to move at least X. And X in this case was most probably in the region of 200 or so basis points, which was really to go towards what was deemed to be a neutral rate, which is going back towards inflation mid-trend growth. So the reality is that I think what he told you and what the Fed's thinking is that they don't have to follow through with the tightening level that they'd had and some of the concerns that could go on indefinitely. So that was a clear positive. But I think that this disinflationary force we've been talking about, that we've seen as well coming through and accelerating from companies and from what we see in the forward-looking profile for inflation numbers that we're going to see printed over the next few months, is that that's going to give them the chance to cut. And so, later in Q2, we think they're going to have more than enough evidence to say inflation profile is getting constructive enough for them to take out some of that tightness of monetary policy. Now, the trajectory from there, I think, is then very much driven by the employment rate, because what happened as a consequence of COVID and the employment dynamics there is that I think central bankers have put away their belief in any NIRU, so non-accelerating inflation rate for a given level of unemployment, and all of a sudden it came back with a vengeance. And so I think they're very focused on the fact that if you have full employment, and full employment in this case being sub 4%, which is where we sit, then to be able to go back to neutral without the risk of actually that the inflation rate will re-accelerate some point is still quite high in their mind. So to us, it suggests there's a pathway which is relatively shallow, 25 basis points as a move, 3 or 4 25 basis point moves, whilst the unemployment rate is in the region of 4%. If it were to start going up towards 4.5%, then I think you will see that they will be more proactive, because then they're taking away one of those concerns they have of the inflation could re-accelerate quickly, and actually showing that the economy is decelerating more than we've seen obviously coming into the beginning of the year. So I think those are some of the factors we need to look for. But our expectations that this will give another tailwind to bond markets and interest rate expectations as we go through the quarter. And one of the reasons I've been trying to take it back is we had one of the fastest improvements in financial conditions. And so another impulse from the economy in the 6 to 8 week period coming into the new year. So, what we're seeing is a degree of jawboning to try and manage some of those expectations down to allow them to be able to move, because, again, they're trying to find this sort of pathway to soft landing, which is historically been very difficult and we've very seldom seen achieved.
Yeah, I think the stats are something like it's been 3 or 4 times over the last sort of many decades. So quite interesting from an Australian perspective. I guess Australia was a bit late to come to the sort of rate hiking sort of mode and the cycle. In terms of rate cuts in the Australian market, I mean, do we think that those rate cuts are going to sort of be synchronised with potentially any US, or might we actually lag a little bit because we came later to the party in terms of raising rates? Paul, I don't know whether you've got any sort of thoughts on that.
Yeah, look, it's interesting. So the last Reserve Bank of Australia meeting just recently, they kept rates unchanged at 4.35%. That's a little bit lower than the US. The inflation is coming down, so people are becoming more confident that they're not going to go up any further, and potentially will come down. If you look at probably consensus in the market is maybe for 2 rate cuts at the end of the year, at the end of 24, as that inflation comes back towards the 2% range. Now, I mean, I think it's an interesting point. I think maybe Australia stays there a little bit longer rather than coming down. It's been, as you pointed out, it's been a shallower curve on interest rates going up. I think they definitely, I mean, the intention of all central banks around the world, and including the Reserve Bank of Australia, is just to make sure inflation doesn't come back, because it's hard once it gets there, it's actually hard to get rid of. So they will follow the data. I think they'll just be on the cautious side. I think an interesting side, maybe this is a bit of a side detour as well, but we're starting to see some stability in a range of these different factors now. So inflation's coming back towards, a target. Interest rates will probably be stable for a while. The currency in Australia has been fairly stable for a while. I just think it's, companies, from a company perspective, companies actually really like certainty. They hate uncertainty. They love certainty. So when you get more stability, what tends to happen is companies do more things. So they're very happy to then, because they're doing projects that might be out 10 years, 20 years. Once they get a bit of certainty and a bit of comfort, doesn't necessarily matter where it is, they now have the certainty to start taking action. So I think it may be a consequence of the stabilisation of a range of these different macros is actually companies go, okay, I can now plug that into my cash flow projections, and now this project stacks up, and I'll move forward with that project. So I think maybe we see, because of that stability, we also see a little bit of more action from corporates.
Yeah, it'll be quite interesting. I mean, it'll be interesting in upcoming sort of earnings seasons and so forth. How much is that reflected in some of the communication from companies, where I guess it's been, some companies in recent times have been a bit coy because there's been a lot of variables, a lot of moving parts, so they haven't been giving as clear of guidance as maybe.
Yeah, and having come through things like the GFC, companies are just, they want to make sure they're on the cautious side. Like I said, balance sheets are in incredibly good shape. So to move from the back foot to the front foot is, that when you get that bit more confidence and get that bit more stability. But you raise a good point. I think as we do go through reporting season, it's one of the points we will be asking a lot of the companies is what CapEx have they got planned? How do they see CapEx developing over the next 12 months? What are the projects? Yeah. What are the return expectations on those projects? Which I think will be some of the most interesting developments.
Absolutely.
So I think it's a really important point, because I think you're seeing it, and I mentioned about our analysts' survey that looking at that 12 months being more constructive. Part of that does come from the fact that they're seeing that actually there's a stability that allows them to plan, and that's why some of that confidence, it's not just an order book issue they're seeing and responding to, it's actually they can make decisions that allow them to think a little bit long term. And it's also, when you look at the context of what we've had over recent years, COVID came, what did companies try to do? Survive. You look at the financing profiles, they tried to get us, obviously interest rates were low. They were getting the opportunity to lock in a certain amount of funding. Obviously, the larger, better companies could really term out that debt and get the full benefit of that cost of debt. But they did it because they wanted to get through the next 2 years, survive, and then see what happens. Reality is, it wasn't about survival. Actually, for many of them, they had a tailwind appear. That move from sort of a goods-based framework into a services one as we've continued. Then we had inflation come with a vengeance. So they had to contend with that. And there's nothing more disconcerting than all of a sudden trying to reprice and understand what those dynamics are through your business. Now, fortunately, they had the ability to pass on those prices. We saw demand being high. But when you step back and all of a sudden those things are all become less of an immediate, I've got to take care of X, and it takes you away from, well, actually, my business is in good shape, balance sheet's looking okay, interest rate profile and financing looks fine, and actually, I see growth of X, for this sector and that we can capture. Your mindset changes. And I think that's really interesting, as Paul was saying, that for Australian companies, but also again back to a global corporate perspective, that how we're seeing some of that materialise in that forward-looking expectation.
Maybe we'll take a bit of a pivot to sort of the world more broadly, and I think one of the areas which certainly for the whole world, but certainly from Australia, is a very relevant topic is China. I mean, it is Australia's top trading partner. Obviously, we're heavily exposed to China, both from a company perspective, certainly resources and so forth. So there's a lot of interest, and the news from China obviously has been fairly negative. Again, if you read sort of the papers, obviously they talk about a lot of capital coming out of China, a sort of lack of confidence by Chinese themselves in terms of the consumers, and there's just a broader thematic, I guess, of just trust in the Chinese government as well. And so interested to explore, I guess, your views on China. Obviously, there's a lot of negativity at the moment. But are there opportunities? What is the market not seeing? I guess which maybe is present.
Yes, I mean, look, you can't ignore that there have been some really very negative themes that geopolitics has been a major issue. Which, you roll all the way back to 2018 and the Trump presidency and how we moved towards a trade war. And really it's been, elements of building up concern, over time on that front, which has manifested itself into, a concern of whether China will stay as a vibrant and a growing country in the way that it has done within the global economy. But I think there's been, some very specific issues that played out. Obviously, the property market, we can't ignore that. It's had, a significant downturn. And it's such a large part of the economy, especially for both the local government profile and obviously the impact onto individuals, because there was a lot of leverage there. That is not something you can just repair overnight. But the reality is that this has been something that's been run over 2 years. Now, part of it was because of a proactive policy to try and take some of the steam out of the property market. But as always, can that get out of control? Some would argue that for a period it really did. And I think it's hard to argue with that. Now they've had to work hard to try and stabilise that as a part of the economy because of its importance. But also, the policy initiatives have just been lacking in clarity and consistency, and that's being polite because the central government, local government, at times it's almost looked like they're totally misaligned, and that has not been very helpful, especially again for confidence for individuals and companies, because they're seeing that at the local government level. They may see policy being announced, but then what does it mean for you in your business or you as an individual and for employment? Because there clearly have been challenges as they've unwound property, healthcare, and technology in stages through the last 3 years. And I think that where we are today, though, is that has happened. Markets have reflected it. They've gone down a lot. The expectations have moved to, you could argue in some cases almost an expectation that there will be no growth in China, which I think is misplaced, that they will do nothing to support the economy, which is completely misplaced. And one of the things that to us is now really interesting is the fact that, and this was typified by some of our portfolio managers and analysts being out in China just recently on an industrials tour. And what stood out is that, yes, there's been real impact onto confidence. Some of the longer term decisions clearly have been impaired to a degree, but order books looking good. Actually, activity is picking up for many of the companies, individual companies we saw. The reality as well, when you look at the valuation of them, is that we have companies sitting in consumer-orientated areas, some of the larger industrials that are not in, where I'd say there's real overcapacity, solar and areas like that, still in areas where you can see growth and also demand outside of China. And they'd been marked down to be in 3 to 4 times earnings, and yet they have no debt on their balance sheet. They see growth in their order books, and I think it's one where, if you were to step back and look at this in any markets that we've seen over time, where again it may feel very uncomfortable, but you're being given the chance to buy good quality companies at that sort of valuation. The reality is, that's where you've mitigated a lot of risk. You've discounted a lot of those concerns, and you have a great entry point for a long-term potential for growth. And I think the only reason you wouldn't see that most probably is twofold, and then that sparks off other considerations. One of them is China's in a depression of some form. But what does that mean for the rest of the world when we're talking about what we were saying about Goldilocks and valuations that have come with that? Well, the second is that they withdraw from the global economy. And that pretty much is going to have the same impact for many of the other countries in terms of the growth hit that come from that. So, we're in the camp that the policy, I think that there's been a lot of international conversation, a lot of international asset owners talking to the authorities and telling them these issues. And also, I think a big part to look out for now as a signal that can be most probably is post any lows forming if they get traction. And our view that a cyclical recovery is showing signs of starting to increase is that they really provide something for the demand side of the economy. So you see something either in the tax structure or other things that policy framework is more broadly to support the consumer. And that's not been part of the past. So it would be, to a degree, slightly radical. But if you see that, I think actually we're going to look back and say those companies really were cheap.
Yeah. Paul, from your perspective, obviously a lot of Australian companies have material exposure to China in different ways. And, we talked about resources and so forth. Again, from a bottom-up perspective, what are you hearing from companies in terms of China?
Yeah, so first of all, I guess China is important to Australia. I mean, we have very complementary economies. Australia is very much primary and tertiary industries. China is secondary industry. So typically what China sells we want, and what we sell they want. So it's sort of natural trading partners. And if you look at some of the big industry, obviously iron ore is the biggest, but also coal, thermal coal, coking coal. Education is one of the largest as well. So a whole range of different sectors and industries. As I said previously, one thing I think is really interesting is given all of that, some of the sort of short-term negatives Andrew was highlighting, that iron ore is sitting at $130, $135 a tonne. Now, that you wouldn't think that's what's happening in China if that price is there. And I guess some of the things we think about is, obviously China is focused on the steel industry and maintaining employment in those industries, but also they're focused on, and I guess that was part of the problem through COVID was it was hard to move, goods and services around, and maybe they want to have a larger inventory and make sure that they've got the inventory of iron ore, as we move forward as well. So. That's definitely sort of been built into the market. Potentially, one of the other ones that gets talked about quite a bit is, China has put large tariffs on Australia's industries like wine, and that's effectively stopped the trade of wine into China. But the government's saying they still feel comfortable that by the end of March, that they're hoping that those tariffs will come off and there'll be a normalisation of trade. So there's still great potential, in those sort of industries as well. We did a survey quite a while ago now, but a survey of intentions of Chinese tourists. So there's a lot of, Chinese tourists want to move around China and they want to look around. That's their number one. I think Hong Kong was number two. But Sydney rated very highly in that as well. So I think same thing, as China industrialises, as people become wealthier, they'll want to travel more. And Australia is a very attractive destination. Education, as I pointed out, Australia is a very attractive destination for both high school education as well as university education for Chinese students. So I think they'll all be long-term. They'll all be long-term positions. Right at the moment, that weakness is playing out in certain pockets. But once again, that's a more cyclical. I'd say that's more cyclical than structural. So,
since we're talking about sort of big sort of global issues, elections. So I think the studies that around 60% of the globe this year will be going through elections. And we know India, Indonesia, but I guess the one where a lot of the focus will be on is the US. Now, does it matter for markets? Obviously, there's a lot of interest, there's a lot of noise. From a market perspective, what are the possible implications, if any?
And I thought you were going to ask me about the UK. The US, yes, of course. I think it becomes more important as the year progresses because, like everything, you become focused onto that dynamic and also what is the candidate saying. Now, we see a lot of things being said at the moment, and that is already influencing markets. I think that to a degree because there at times there's expectation, and obviously that expectation today is that the chances of Biden being able to win the election, are looking challenged by how strong the Trump one core vote is, and then the degree to which the disapproval ratings that Biden has seen because of the cost of living challenges, has not really declined. And so I think, in the short term, there's going to be a degree of focus on, can they build any momentum through the fact that this disinflationary force we've been talking about actually shows up and changes, individual voters within the US's perception of the economy, and therefore be more constructive, which will be good for the incumbent. I think there's a question mark there,
Mm-hmm.
And so that may just sort of appear and give a bit of a tailwind, but I think that Democratic leadership must be looking at this very closely and really will want to see some sort of turn over the course of the first quarter. So I think that's quite an important element from here. I mean, look into the election itself. I suppose whoever walks through the White House door is, I think, going to have some pretty interesting baseline considerations. A budget deficit which is larger than any time outside of the wartime periods. We're seeing obviously that degree to which the COVID stimulus has actually been maintained and continued, and what that's done for the debt profile, and that is certainly we've had little shots across the bow, which I think will become much more of a focus, post the election. But also then what's their policy? And the thing that obviously is slightly worrying, and I think it does have back to the impact on markets, that I think one of the reasons that the dollar has done slightly better in the recent past is the degree to which people are thinking actually Trump will win. And all he's talking about is imposing tariffs the moment he gets into the president's seat. And that have been aimed at Europe to start. Again, there you've got an element where the markets are looking back, 2016. They feared him coming in, and actually then you got this burst of tax cuts and deregulation that gave a very positive profile. But in effect, what you're getting is him walking through the door and doing what he did in 2018, which was not so encouraging. Import tariffs go up. Those ultimately are going to be challenging for the US consumer, but he continues to believe that. And this, I think, is a very interesting part about politics and geopolitics at the moment, that it's behaving as if, the pie can be smaller, but if I have more of it, I'm happy. And so you're seeing, I think, generally non-economic actors, and by that is meaning, sadly, what we've seen with Russia in the Ukraine war is that, I'll lose, but you're going to lose more. And that I find a troubling thought if that is, how the sort of premise for the US policy is going to be, and that is a risk. But I think that most probably, and Paul and I were chatting about this, that what would be the thing that most concern you? It actually would be that Trump doesn't win, but he loses by such a fine margin, and there's so many, back to 2020, that this time it's even more of a fracturing, within the US, and that I think would be the more worrying because of the implications of, US and its importance in the global economy, global politics, all of a sudden going through a complete domestic implosion.
Well, no doubt everyone will be keenly watching it. So, final question to leave today's podcast with, and I guess it's more around opportunities. And despite there's a lot of moving parts, obviously we've talked about geopolitics, inflation, all of those sort of things. But in terms of investment opportunities, what are maybe some of the sort of top two areas that you're sort of focused on at the moment that you see there's definitely some opportunities to explore?
So I suppose one is that, is thinking, what are structural opportunities regardless of, and so we think just really seeing things around the soft land encouraging disinflation, but growth developing and having positive impacts. If I'm honest, that one of the standout places for this is Japan.
Mm-hmm.
So see that as a massive opportunity because basically the big part is that the break-in of the psychology of deflation. And that really feels to have happened, but also the positive dynamics that flowed through, and I won't touch them all, but just that how that's led into companies behaving differently. 10 years of Abenomics has created a swing towards corporate governance changes that now have companies looking at return on equity as top of their list of what they need to achieve. That's a phenomenal change, and what it means is that you're getting some very virtuous developments, capital coming back, building of new plants, margins being restored, prices go up, but wages go up. All these things creating a reinforcing process. And also geopolitically, Japan is a big partner to China, as well as obviously very close to the US. And so getting some of the benefits from supply chain movement. So that's interesting. I think that the soft landing narrative more for the developed world and looking back to the US and maybe to Europe and even to here, I think Australia, that if this is going to continue to play out, which we think it is for a while, then you look around and say, what has really suffered from the last few years of dynamics of very much obviously a mega cap, but also large cap outperformance, and the mid cap space looks very attractive. They're going to get benefits of refinancing being lower, the multiples on earnings today, and yet the earnings outlook is looking very constructive. You should see an ability to make up some of that lost ground over the last few years. And then I suppose the last one is just coming back to bond markets that, as I said, we're going to have another run of interest rate expectations for yields to go lower. The yields backing up, intermediate investment grade all of a sudden looks more attractive again. You've got some spread relative to where for cycle outlook, it looks pretty good, but also you've got some duration for that yield decline that we think will occur as we go through the first half of the year.
Excellent. Paul, any final comments from yourself in terms of opportunities?
Yes, I think it's going to be a really interesting year, 24. Andrew touched on, we have an analyst survey that, we have 20,000 meetings, company meetings, whatever. So it really is a fantastic source aggregating all of that data together. And once again, as Andrew pointed out, it's the outlook is better for the next 12 months. So one of the things we're really looking at in 2024, and in Australia, we still think the economy will slow through the year because of that higher interest rates. The consumer has come under pressure, and it'll be interesting as we go through reporting to season just to see where we are in that space. But I guess we would be looking, so markets look 12 months ahead. They don't, they're not about what's happening right now. So we're increasingly thinking about becoming less defensive and more offensive into a cyclical recovery. So to me, that's going to be the really interesting space that we'd be watching closely and talking to the companies. But once again, you've got to get ahead of it. You can't just be, as it happens. But to me, that's going to present a lot of really interesting, very company-specific opportunities in 2024.
Gentlemen, thank you for your time. That was a fascinating discussion. So thank you very much, and safe travels, Andrew, back to the UK.
And I did want to say, Andrew, thank you. It was great to have you in Sydney. You please come down, more, as much as you want. But I also wanted to welcome you to the Sound. This is your first Sound Bites. I know you're a podcast specialist, but this is your first Sound Bites podcast.
It is. I was very excited that I'm glad that one, you invited me, and two, I've become part of the Sound Bites crowd. It's excellent, and I assure you, I'll be coming back. If you keep on inviting me.
Excellent.
Thank you for joining us this month. If you'd like to get any further information regarding Fidelity, please hop onto our website at fidelity.com.au. If you do have any feedback in relation to podcasts or any future episodes you'd be keen to hear, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.